Welcome to EnrichMinds.com and to our session today in Understanding Risk and Reward. In our session today, we shall study what is risk, how to evaluate risks associated with our investment decisions, and how to make better and informed investment choices. Let's dive in. In the first section, we shall look at risk. We have to make decisions every single day. Many of these decisions involve some element of uncertainty and hence risk. How we make decisions will determine the outcome. Let's watch a short video to understand how decision making involves risks every day.
This is Mo. He may die in a few moments. He's been offered fugu, the dish made from the most poisonous fish on the planet. If not prepared properly, a dish that can kill. Mo is trying to decide whether to eat it or not, but there are a few things he needs to consider. Firstly, Mr. Hishikawa, CEO of a global blue-chip corporation, a known traditionalist. He's wondering how Mo will react to his generous offer of this Japanese delicacy. The source of Mo's dilemma: a contract awaiting Mr. Hishikawa's signature. A contract worth 27 million rands. Mo's boss, Howard. Business is not good. He needs this deal to go through, or he's through, which means Mo's through. Candace, Mo's ex, is inconveniently at the same restaurant on the very same night, having a wonderful time with her new boyfriend. This is not helping Mo's decision. Then there's this man. He isn't enjoying his miso. If this restaurant can't cook soup, what about the most dangerous recipe in the world? Finally, the head chef. Learning to prepare fugu takes almost a decade. He can't be older than 20. There are only 2 chefs in the country that have a fugu license. What's the chance he's one of them? What will Mo do? You decide.
So, what is risk? All investments come with risk. With financial investments, risk is usually tied to reward. That means investments with the potential to return the most also usually have the potential to lose the most. And safe investments typically do not return much. Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from an expected outcome or return. Risk includes the possibility of losing some or all of an original investment. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. Overall, it is possible and prudent to manage investing risks by understanding the basics of risk and how it is measured. Learning the risks that can apply to different scenarios and some of the ways to manage them holistically will help all types of investors and business managers to avoid unnecessary and costly losses. The risk-return trade-off is the balance between the desire for the lowest possible risk and the highest possible returns. In general, low levels of risk are associated with low potential returns, and high levels of risk are associated with high potential returns. Each investor must decide how much risk they're willing and able to accept for a desired return. This will be based on factors such as age, income, investment goals, liquidity needs, time horizon, and personality. The chart shows a visual representation of the risk-return trade-off for investing, where a higher standard deviation means a higher level of risk, as well as a higher potential return. In this section, we shall turn our attention to the types of risks. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risks affecting asset values into two categories: systematic risk and unsystematic risk. Broadly speaking, investors are exposed to both systematic and unsystematic risks. Systematic risks, also known as market risks, are risks that can affect an entire economic market overall or a large percentage of the total market. Market risk is the risk of losing investments due to factors such as political risk and macroeconomic risk that affect the performance of the overall market. Market risk cannot be easily mitigated through portfolio diversification. Other common types of systematic risk can include interest rate risk, inflation risk, currency risk, liquidity risk, country risk, and sociopolitical risk. Unsystematic risk, also known as specific risk or idiosyncratic risk, is a category of risk that only affects an industry or a particular company. Unsystematic risk is the risk of losing an investment due to a company or industry-specific hazard. Examples include a change in management, a product recall, a regulatory change that could drive down company sales, and a new competitor in the marketplace with the potential to take away market share from a company. Investors often use diversification to manage unsystematic risk by investing in a variety of assets. In addition to the broad systematic and unsystematic risks, there are several specific types of risk, and we shall study each one in some detail next. We shall study each of these business risks: business risk, credit or default risk, country risk, interest rate risk, and liquidity risk. Business risk refers to the basic viability of a business, the question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover its operational expenses and turn a profit. While financial risk is concerned with the costs of financing, business risk is concerned with all the other expenses a business must cover to remain operational and functioning. These expenses include salaries, production costs, facility rent, office, and administrative expenses. The level of a company's business risk is influenced by factors such as the cost of goods, profit margins, competition, and the overall level of demand for the products or services that it sells. Credit risk is a risk that a borrower will be unable to pay the contractual interest or principal on its debt obligations. This type of risk is particularly concerning to investors who hold bonds in their portfolios. Government bonds, especially those issued by the federal government, have the least amount of default risk and, as such, the lowest returns. Corporate bonds, on the other hand, tend to have the highest amount of default risk, but also higher interest rates. Bonds with a lower chance of default are considered investment grade, while bonds with higher chances are considered high yield or junk bonds. Investors can use bond rating agencies such as Standard & Poor's, Fitch, and Moody's to determine which bonds are investment grade and which are junk. Country risk refers to the risk that a country will not be able to honor its financial commitments. When a country defaults on its obligations, it can harm the performance of all other financial instruments in that country, as well as other countries it has relations with. Country risk applies to stocks, bonds, mutual funds, options, and futures that are issued within a particular country. This type of risk is most often seen in emerging markets or countries that have a severe deficit. Interest rate risk is the risk that an investment's value will change due to a change in the absolute level of interest rates, the spread between two rates, the shape of the yield curve, or any other interest rate relationship. This type of risk affects the value of bonds more directly than stocks and is a significant risk to all bondholders. As interest rates rise, bond prices in the secondary market fall, and vice versa. Liquidity risk is associated with an investor's ability to transact their investment for cash. Typically, investors will require some premium for illiquid assets, which compensates them for holding securities over time that cannot be easily liquidated. Counterparty risk is the likelihood or probability that one of those involved in a transaction might default on its contractual obligation. Counterparty risk can exist in credit, investment, and trading transactions, especially for those occurring in over-the-counter or OTC markets. Financial investment products such as stocks, options, bonds, and derivatives carry counterparty risk. After deciding how much risk is acceptable in your portfolio by acknowledging your time horizon and bankroll, you can use the investment pyramid approach for balancing your assets. This pyramid can be thought of as an asset allocation tool that investors can use to diversify their portfolio investments according to the risk profile of each security. The pyramid, representing the investor's portfolio, has three distinct tiers. First, the base of the pyramid. The foundation of the pyramid represents the strongest portion, which supports everything above it. This area should consist of investments that are low in risk and have foreseeable returns. It is the largest area and comprises the bulk of your assets. Second, the middle portion. This area should be made up of medium risk investments that offer a stable return while still allowing for capital appreciation. Although riskier than the assets creating the base, these investments should still be relatively safe. Third, the summit. Reserved specifically for high-risk investments, this is the smallest area of the pyramid or portfolio and should consist of money you can lose without any serious repercussions. Furthermore, money in the summit should be such that you do not have to sell prematurely in instances where there are capital losses. Risk-reward is a general trade-off underlying nearly anything from which a return can be generated. Anytime you invest money into something, there is a risk, whether large or small, that you might not get your money back, that the investment may fall. For bearing that risk, you expect a return that compensates you for potential losses. In theory, the higher the risk, the more you should receive for holding the investment, and the lower the risk, the less you should receive on average. You alone can figure out where you want to be in this risk spectrum. Since risk and reward go hand in hand, you can rank investment types according to their risk and potential return. Choosing the right balance of risk and return is arguably the most important part of investing. Your risk-reward balance is described by your asset allocation. We shall discuss asset allocation and diversification in the next session. For now, let's watch a short video on risk, courtesy of Investopedia.
Risk is something that most investors try to avoid. The riskier the stock is, the more return there should be to compensate for taking on that risk. Risk in investing is measured by something called standard deviation. It is a measure of how much the stock price swings high and low compared to its average price. A low-risk stock will have small swings, and therefore be more predictable. But a risky stock is unpredictable with larger swings. Risky stocks can be profitable as long as you get out during a high, but sometimes you're forced to take out during a low, and this is when you need to consider your time horizon. Time horizon is the length of time you can part with your money before you need it again. If you have a long time horizon, you can wait out any large dips, so you can have more risky investments. But if you plan on taking out your money within the next year, you would have a short time horizon, and you might be forced to withdraw during a dip. The shorter the time you have, the less risk you can take. This is why your financial advisor needs to know your time horizon before they can choose the right investment.
So, in summary, our main takeaways from today's session are: all investments come with their own risks. One has to understand one's own risk profile and appetite for risk before embarking on making investments. It is important for investors to understand the idea of risk and how it applies to them. Making informed investment decisions entails not only researching individual securities, but also understanding your own finances and risk profile. Thank you for your time, and until next time then, stay enriched and strong.